Hello everyone, welcome back to another video. So in this video, I'm going to be breaking down exactly how the market actually moves. Because believe me, the amount of stuff I see online and what people generally say, oh, this is what makes the market go up or this is what makes the market go down, is completely false. They completely misunderstand the actual market mechanics, okay, of why it goes up, why it goes down. And once you know actually how it works, when you use order flow then, you can kind of, you really do understand, okay, there's more chance it's going to go up, there's more chance it's going to go down. You understand the story and you can trade a million times better. I promise you that. So it is well worth to really watch this video, try to understand what I say here. It's actually very simple because it's really going to help your trading. So first things first. What makes the market go up and down? Essentially, yes, the price of any asset, regardless of what you're trading, whether gold, NQ, NASDAQ, S&P 500, doesn't matter what it is, right? It is dictated by supply and demand. Now, this is where most people get it wrong, okay? Most trading gurus or whatever online, they will say buyers are demand, sellers are supply. That's completely false, all right? Buyers are demand and sellers are demand. Buyers and sellers are also supply. It works both ways, and I'll explain how that works in a moment, okay? But let's just take, for example, a real-world example. Imagine I'm selling these headphones, okay? I've got 50,000 available for sale, and I price them at $20. Okay, cool. I'm not getting much interest. No one really wants to buy it at $20. I'm struggling to sell the whole 50,000 units. I've only sold a trickle of them. What do I do as a human being, as a businessman, right? What can I do to make, more sales? Well, naturally, of course, I'm going to drop the price. So maybe I drop it to $10 a pop. And now all of a sudden, everyone wants to buy it. I sell through the whole 50,000 units like that, okay? And I'm like, oof. Sold that a bit quick, actually. I could probably, and there's more people out there saying, oh, do you have any of these headphones for $10 available? I want to buy more, and I've run out of stock now. So maybe on my next, stock run, when I buy more of these or get more of these or make them, whatever, and I get the next 50,000, maybe I shouldn't price it at $10 because that was a bit too cheap. Okay, so I'm going to price it at $15, and that's the kind of perfect balance. I managed to sell all 50,000 units, and the demand for it is kind of roughly with how much supply I have available, and I make the most money and everyone's happy. Okay, so simple terms, when demand is high and supply is low, prices go up. When demand is low and supply is high, prices go down. Okay, everyone kind of understands that concept. It's really easy. But the only reason, when I initially sold these for $20 a pop, the only reason price went down was my decision, right? Me as a human being made that decision. If I didn't do anything, nothing would have happened. The price would have stayed at $20. Sure, I wouldn't have sold any, but it wouldn't have affected the price, right? The price only moved down because I decided to lower the price in order to make more sales. Now, this is the part where people get it wrong, right? And the market's no different. The market's not going to lower the price of an asset, okay, only because there isn't demand. That's not how it works, okay? If there's no one interested in buying and selling, the price will remain flat, right? If no one buys gold or sells gold aggressively, price ain't going to go anywhere. There could be, a million people wanting to buy gold at $4,000 an ounce, but if there's no demand, so no aggression in the market, price is going to remain flat. It doesn't matter how much supply there is on either side. It will stay flat price, okay? It won't go anywhere. It's demand that moves the market, okay? So to better understand this concept, think of it this way. So we have at any point 4 participants in the market, okay? So we have aggressive buyers, right? Aggressive sellers, and passive buyers. Okay, now the aggressive people, so aggressive buyers and aggressive sellers, they are demand. Passive sellers and passive buyers are supply. Okay, now these guys, so the passive guys, they do not move the market. They cannot move the market. Okay, it's only the aggressive people that move the market. And the way it works if we take the headphones as an example again, is imagine, all right, we have some passive buyers of these headphones. Okay, so people who want to buy these headphones and they want to buy it at $15 a unit. Okay, and that's the price they want to buy it. They're waiting for someone to approach them and say, hi, I have some headphones available for sale and I'll sell them to you at $15. Only then will they be like, great, I'll buy them off you. Okay, they're locked in that price. Then you have passive sellers as well. Okay, people who want to sell these headphones for $17. Okay, and they're similar to the buyers, right? The passive buyers. They will not budge on price. They will only sell these headphones for $17 a unit if a buyer comes along and says, hey, I want to buy these headphones for $17. Then they will be like, yeah, great, I can do that deal. Okay, but otherwise, if it's just, you know, now we got these sellers who want it for who want to sell for 17, and you got these buyers who want to buy for 15. They're never going to transact. These guys are never going to transact with themselves. Okay, they can't. All right, they're at different price points. All right, and they're both passive. Okay, these are people who place limit orders in the market. All right, that's the order book, and you'll see it on the depth of market. It's I'll put up a picture or a video or something now, and you will see, you know, these are limit orders. These are people who essentially at that price is where they want to get executed at. They cannot move the market. So you can have a million passive sellers, a million passive buyers. Doesn't matter how many there are. They're not moving the market. It's now these aggressive buyers who will transact and move the market. So let's take, for example, we got some passive sellers. Okay, we got passive sellers at $17 per unit here. All right, and they have 5 of these headphones available. There's a passive seller who's willing, the lowest price, the best price for, you know, the lowest price someone is willing to sell passively is $17 at this moment in time. They have 5 units available. An aggressive buyer comes along and they say, and aggressive people are basically people who are willing to enter at whatever the best available price is. Okay, they are willing to buy or sell at the best available price. So this aggressive buyer comes along and says, I would like to buy 6 of these headphones at the best available price. The market then will look at their order book and they'll say, right, you want 6 units at the best available price. The best available price right now is $17, but there's only 5 of units available at 17. There is, however, another unit available at $18, so I can do 5 orders, 5 units at 17 and 1 order at $18. There you go. The aggressive buyer, cool, done, transacted. All right, so that aggressive buyer now has 5 headphones at $17 and 1 for $18, the next best available price, right? So he's bought out that level at 17. So what happens to the price then? Well, the price was, you know, $17 back then, but now that that buyer's come in and cleared 17, the best available price is now $18. Okay, so you would see on a candle, boop, it will go up a little bit, right? It's now $18. And the same happens on the other side, right? If, you know, the best available passive buyer is $15 and you got an aggressive seller coming in now saying, look, I want to sell 5 of these units, all right, or let's say 6 of these units at the best price available on the order book, and there's only 5, you know, there's only a passive buyer willing to buy 5 at $15, okay, but there's more willing to buy at $14, the market will look and say, right, okay, you want to sell 6 of these at the best available price. The best available price, we have 5 available at $15 and 1 available at $14. Seller goes, great, transact, and now the price has moved down to $14. Okay, so that's why price goes up and down, ticks constantly up and down, because all these people are transacting. So it's just, you know, if you look at like the 1 second chart, it's just up and down like crazy, right? Because you've got all these little transactions going on constantly, and that is essentially what moves the price up and down. Now, what actually makes price really move? Okay, I'm talking, trends actually, push up a reasonable amount, not just little ticks. Well, this is where it gets interesting. Now, let's say Walmart enters the room, okay, and Walmart wants to buy 10,000 of these headphones. Okay, the market looks at it. Now, if Walmart goes in aggressively and they place an order for 10,000, the market's going to look at the order book and say, whew, there's not 10,000 available. You're going to have to move the price a lot in order to find 10,000 passive sellers, right? And now, for example, imagine, there are 5 units available at $17, and there's, 20 available at $18, and, it just keeps going up, right? And there's maybe, 15 available at $19, whatever, right? Okay, you get the drift. So it keeps going up all the way up in price until all those 10,000 have been filled. But what is actually going to happen with the price? The price is just going to gap up massively, instantly, right? But Walmart doesn't want that to happen, because Walmart's only bought 5 at 17, they've bought 20 at 18, they've bought 15 at 19, they've bought, 50 at 20 or whatever, right? Their average price per unit of what they've actually purchased each headphones at now is way more than 17 at the price that they initiated the purchase for, right? The price has gone up so high, it's maybe at like $60 now until their 10,000 units have been filled. They're paying an average of maybe like $50 per headphone. That's not good for Walmart, right? They wanted to buy it at $17, but their average price has worked out to be $50 because they placed the order all in one go, clearing all those price levels, right? All the available supply, okay, on all those price levels. So that's not good for Walmart. So instead, what does Walmart do? Well, they don't become aggressive. They're not going to be aggressive. They're going to be passive, okay? So instead of, buying aggressively, they will be passive at, let's say, $16, okay? Walmart has set their passive order at $16. So now, when aggressive sellers come in and say, what's the best available price for these headphones? I would like to sell 20 of them. The order book will look and say, we've got, there's more than 20 available at 16. That's absolutely fine. We can sell it $16 per unit. Aggressive seller, great. Sells 20 units, 20 headphones to Walmart at $16. Walmart's still sitting there, just relaxing. Another aggressive seller comes in. I've got 100 headphones to sell. Best available price, please. Order book looks, says, right, $16. Yeah, we can fill the whole $100 order. 100 unit order at $16. Great. They sell 100 units to Walmart at $16 each. And they do that until their whole order is finished. Right now, after however long, of all these aggressive sellers coming in, is basically selling all their units just to Walmart for $16, right? Because they're the best available price at the moment, right? Best available buy at the moment. Then, Walmart's filled, they've now got 10,000 headphones at $16 each, right? Not at the higher price because they pushed the market up. They've got it now at a good price, $16 each. They're happy, Walmart. Now Walmart will enter and buy a bit aggressively, okay? They'll start buying aggressively to push that price up, right? So they might buy an extra 1,000 units aggressively, get that price going. The price now jumps to, let's say, $25 because Walmart has just aggressively bought, right? Now each unit's worth $25, okay? And everyone else is looking and saying, oh, wow, these headphones, they were at like $16. Now they're at $25. They just jumped up. I'm going to buy some because I think it's going to keep going up. So everyone's now buying these damn headphones, right? Because they think this is going to keep getting better in price, right? Walmart at this stage says, I think I'm quite happy with that. I bought 10,000 units at $16. Price is at $25. I'm going to start looking at unloading my stock. So Walmart now becomes You've guessed it, a passive seller, right? Okay, so now they're available. All these people want to buy because they think the price is going up even more. Walmart is now selling these units at $25 a pop, okay, to all these other people, and they're all buying it, and eventually they unload the whole, 10,000 units, and Walmart have just made a very healthy profit. That is how the institutional money flow works. That is how institutions enter, exit the market. They don't enter in one go, they break it up passively. They are passive. Institutions are essentially supply in order to fill an order. Okay, very, very important. All right. So if you're looking at just the candlesticks in this scenario, what would you expect to have seen? Well, you would have expected, originally price was at, I think it was like $17, $16, whatever. And then it just kind of stayed there. It doesn't really go anywhere, right? Because, people are buying and selling. It's ticking up a little bit, but no real volumes in the market at this moment in time. It might go up to $19 and then drop back to 16, then back up to 18, then back to 15, then back up to 19, then back. But it's just going sideways. It's in a range, right? Because there's no real major volume. There's no real major orders coming in to push that market beyond that kind of fair value range, right? And then Walmart came in, right? And they placed a big passive order, okay? An iceberg order, as we call it, right? And what would you have seen? Well, you would have still seen it go sideways, right? It wouldn't have moved the price. But what you would have noticed is that around $16, where Walmart was, willing to buy passively, you would have seen a lot of sellers, right? You would have seen all these aggressive sellers. And remember, the footprint only shows aggressive buyers and aggressive sellers. It does not show the passive buyers or passive sellers. So the footprint market, the chart on the footprint, you would have seen at price level 16, a bunch of sellers. So many sellers, right? 10,000 to be exact, more than 10,000, right? Sellers, units sold of these headphones, all at $16, but the price didn't go lower than $16. That's when you would have been like, what is going on here? There are 10,000 units sold at 16, but it didn't go any lower. Well, the only logical conclusion is that there was a big passive buyer at $16 absorbing all those aggressive sellers. Why? Because they're building up a big order, right? And if they're building up a big order, they're probably going to want to push that market up. So the moment those aggressive buyers come in, i.e. Walmart, again, being a bit aggressive to get that market up, that is, that's going to push the price up then. And that is essentially how it works. That's how institutions manipulate price. And that is what you're looking for on the footprint, essentially. You're looking for big volume, right? And things that don't make sense. And I always talk about market efficiency, but it's the same idea as absorption, right? If there are, 500 contracts sold on one price level and the price doesn't go lower, it's because there is a big buyer passively absorbing all those aggressive sellers. There's a reason it didn't go lower, because there is a big buyer in the market. They're just not on the footprint. They are passive, okay? And believe me, they're going to try and get that market up, all right? They don't always succeed because it's not just one institution. In this case scenario, I'm just talking about Walmart being the only big institution. If it was only one big institution, it'd be very easy to track. But in the real world, in the real market, it's not just Walmart, it's Amazon, right? It's Target. It's all the big retailers out there. They're all fighting and battling it out as well, okay? So someone's going to lose at some point, right? And that's how the footprint is, that's how the NQ and the market is as well, right? You've got loads of institutions, hedge funds, banks, whatever, right? They're all fighting each other as well. They don't care about the retail traders, right? They're fighting each other, essentially. So yes, sometimes, they fail to get the market up or they fail to get the market down, right? And they make a loss too. But if you're able to spot when there is clear absorption in the market on the footprint, clear absorption, if you're able to spot that, you can take advantage of it. So let me show you on the footprint that absorption. Okay, So have a look at this, right? Here's the footprint. Look at just the volume, okay, on these two candles right here, right? If you look before, the volume was just generally, pretty average. And then all of a sudden you get this massive influx. What is going on here in these two candles? Well, these are all aggressive buyers. Remember, all right, aggressive buyers will move the market, right? They're all buying. But then we just fail and reverse. Why is that? Because there is a big institution, and when I spoke in my example about, on one price level, they don't just put their trade passively on one price level. That would be too obvious, right? They scatter it over an area, okay? Again, just to try and be as invisible as possible, okay? So they're scattered. There's a big institution here wanting to sell, all right? And all these aggressive buyers are just feeding all this big institution, feeding their big sell order. Then a bit of aggression comes in from the sellers, okay, and really push the market down, right? So that is how you see it. Whenever you see heavy volume but not much follow through, that's absorption. That's all you're looking for. Heavy volume, not much follow through, and then as soon as that reversal and aggression comes in, that is your cue to jump in the market, okay? So that is how the market actually works. Remember, supply and demand, okay? Buyers are not demand, sellers are not supply. It's actually aggressive buyers and sellers are demand, and passive buyers and sellers are supply. It works both ways, okay? And once you understand that, and that's the example of the headphones that I, gave. Once you understand how it actually interacts the market, you can figure out the footprint a bit better. Now, sadly, as the time of recording this, this is New Year's Day right now, so the market recently in the last few days has been not that good because, naturally there's not many participants in the market, so it's harder to find a perfect example. But if you look back in my other videos, I've got many videos where I break down a lot of trades I actually took in real time on lives, and I show, the absorption, I show the aggression. If you look at my last live stream, I show the footprint and my actual trade, and you can see in real time how that absorption happens. So it's well worth watching that with the knowledge that I just shared today and putting the two together, and you'll see, aha, the light bulb moment will go off, okay? It's actually very simple. Just remember, there are passive and aggressive participants. Aggressive move the market, but passives can also build up and stop the market from going anywhere if they are absorbing all the aggression. So the worst thing you can do when you get into the order flow and get into footprint trading is just follow high volume. You'll get annihilated if you just follow high volume. See big sellers, oh, it must go down, sell. Nope. See big buyers, oh, it must go up, buy. Absolutely wrong, right? You've got to read the market story. Try and figure out what is actually going on here. Are these people exiting the market? Are they entering the market? Are they building up an order? Is there a, you've got to look at the story of what is actually happening. Put the volume with the movement together, figure out the story, and then you can understand what is most likely going to happen next. So, guys, I hope that was a useful video. I hope you learned a lot. If you would like me to break this down again or go into more detail, or I don't know, hopefully I tried to explain it as clear as possible. But let me know in the comments what else you would like me to break down. I am going live every trading day, New York Open, so do join me for the live stream. Subscribe, turn on channel notifications so you don't miss that notification of when I go live. But every trading day, New York Open, that's 9:30 Eastern, I'll be live. So be awesome to join, come trade with me. We have a great time, and everyone's generally very happy. So it's good stuff. But apart from that, thank you all for watching, and I'll see you again very soon. Take care.